Okay, in this video, I'm going to be talking about 3 stocks that are potential buys right now that you can go and do your own research and due diligence on them, but just to spark some ideas and potentially maybe add it to your watch list. Keep an eye on these and let's get right into it. So, my name is Pierce. I am building investorwaves.com, which is a tool that extracts stock ideas and commentary from the top YouTube channels and podcasts. So this is an example screenshot where we take all of the transcripts and put them through AI and extract any actionable takeaways on stocks. And we send out 3 stock ideas every day to your email, and that's completely free. So if you want to get those in your email, click on the link in the description to get that. And getting into the first idea is Roku. So Roku is the company originally making the streaming players for TVs, and over time they've kind of shifted more and more towards their streaming platform and their advertising business. So it's not just hardware, and they've got the hardware side of it, which is like their devices and their Roku branded TVs and their streaming players, and then the other side of it is their software, their licensing, their Roku channel advertising, all the kind of higher margin stuff on their platform side is which I believe what they call it. And their mission really is to be the streaming platform and to dominate the TV ecosystem, right? And so they claim to be the number one streaming TV operating system, OS, in the US, Canada, and Mexico. So when I heard that and read that, that kind of opened my eyes to the scale of Roku and where they're at, because I've never personally used Roku, but they are a very big business. And in investorwaves.com, we actually caught Parkev here, a YouTube channel, talking about how Roku is a buy for him, and he looked at the company's valuation and ran it through his discounted cash flow model. And Roku is currently sitting at, I believe, $94 per share. And in his discounted cash flow model, he valued Roku at $11 per share. So with applying a bit margin of safety, Roku is potentially fairly valued to slightly undervalued. He really likes the business even at current market prices and likes it as a long-term opportunity for investors. So he is giving this as a buy recommendation for Roku stock. And so I saw this on investorwaves.com, decided to look into it a little bit further, and kind of looking at Roku from a financial standpoint, their operating cash flow to sales ratio has improved 9%, which is the highest in a decade. And I looked at their return on invested capital, which is, you can see it over the years here. It really started peaking. They had a huge boom during COVID, and then down in 2022, they kind of moved from a 22% ROIC metric down to a negative 30%. And that is because of obviously COVID happened, but then COVID brought on a lot of inflation, a lot of market demands that Roku actually decided to not raise their prices during this time. And so that kind of explains this dip here, but they have steadily increased their return on invested capital year over year, which they're almost back to where they were during that 2020 year at 2%. Or excuse me, the only year that it was actually positive was this 2021, but they're almost up there and they're trending in the right direction in terms of their ROIC. And then speaking of discounted cash flow models, I actually read this article about Roku stock and how Simply Wall Street actually approached their analysis with it from 2 different angles. The first was a discounted cash flow model similar to the one we were talking about here, and they came to the conclusion that the current price, which this is a little bit wrong as of today's numbers, but they came up with a fair value of $163 per share for Roku. It's currently sitting at $95 per share, which that does seem a little bit aggressive, but this suggests that Roku stock is trading at a large discount compared to its fair value from Simply Wall Street. And this is just one approach though. So if you look at the other approach, which is looking at Roku price to sales, and this P to S ratio is often a better valuation tool. So in something like Roku, which is a fast growing tech and entertainment stock in that sector, you usually look at multiples for a profit to sales ratio of average about 1.65x, while Roku's peer group averages 3.97x, and Roku currently trades at a ratio of 3.15x. So Simply Wall Street, using this approach, actually came to the conclusion that Roku was just slightly pricey and slightly overvalued compared to its fundamentals. So keep that in mind, that there's no one way to value a stock. Obviously there's many ways, but and in this I've talked about two ways using the discounted cash flow where people came to the conclusion of it's slightly undervalued, but there are other ways to kind of come to this conclusion, and in this instance they came to slightly overvalued, which I am interested to see if they slightly overvalued it at $101 a share, and maybe it is actually undervalued according to the price to sales ratio at $94 per share, what it's currently trading at. So that would be interesting to get clarity on. But to kind of wrap this stock idea in conclusion, Roku looks good in the long term because they have a growing business in a growing sector, and they look okay fundamentally. There are some short-term cautions because of current price increase in the stock and things with the valuation getting a little bit tighter. But I think the management does look good for Roku. They prioritize user growth in the right times, as you can see through COVID, when they had a obviously once in a lifetime opportunity, everybody in their homes watching TV. And so that is going to wrap it up for Roku stock. Okay, and the next idea is ticker CDZI, known as Cadiz. And this is a water company. They develop and manage water and agricultural resources. So they manage groundwater, water storage, all sorts of things for customers in the United States. And they own 45,000 acres of land and all the groundwater underneath it, especially in California is kind of where they're focused. And they basically are betting that the groundwater storage that they have becomes increasingly valuable as the problem of water in California, Southern California area becomes more scarce. And so they're aiming to develop this land into commercial and residential development as well. That's something they're looking toward to. And they have also some agricultural assets that are being leased as things like grape vineyards and things like that. So the stock has seen tremendous growth in the past year. Since the start of the year, they kind of started out at $5 a share but they've seen tremendous growth, I should say, since April, not since the start of the year, starting at $2 a share, and they got up to almost $6 a share. But today it's actually trading down 8% here on the weekend. So I saw that Lance actually went on Market Beat's YouTube channel and he called this stock out as a potential buy, and he could see this being a growth story that maybe hits the double-digit mark, so $10-12 a share by the first quarter of 2026. So this came out before this slight dip we're seeing right now. He actually called that a few days back, maybe when it was closer to $6 a share. But this caught my eye because he's talking about this stock showing growth potential, and now it's pulling back a little bit, so maybe you can get a better entry. And a little bit more about this stock is something that was very, very interesting, which kind of prompted Lance to talk about it, was a huge amount of premium order option volume and flows flowing into the stock for November calls, about $1.3 million. And that was on October 2nd that this guy had tweeted that. So that was very interesting to see. And another interesting thing I came across when researching this briefly was that, at least as of September 25th, that the general public only owns about 25% of the stock. Private companies, 31%, and then 41% of the stock is to institutions. So there's a lot of buy-in to the institutional buyers. And this could potentially be a bullish sign, but like it's kind of outlined here in the news article, it's best to be wary of relying on this, solely for validation, because investing's hard and institutional investors get it wrong sometimes as well. So just an interesting thing to highlight there. But the 2025 revenue of CDZI stock is up about 700%, I believe. So this is a stock that has been running and then pulling back and running again, and now it looks to be pulling back just a little bit. But add this to your watch list, and another stock here to look into. And the last and final stock idea is AMD, one of the hottest stocks on the market right now. And this is a trade call or kind of bullish outlook here from, I believe it is Jose Najarro, who is talking about AMD on the back of this new Oracle GPU order. The news just came out a few days ago, and he believes AMD is on its way to be $1 trillion company in the next 5 years. And so they've had a lot of momentum from their previous partnerships, namely, they had the huge OpenAI announcement earlier this month that sent the stock way up. And he thinks that the future revenue potential of these partnerships and these deals with OpenAI and Oracle, and I believe maybe even Meta has a deal with them as well. Might be wrong on that. But he thinks this makes their future revenue potential underestimated by current analyst estimates. So looking at the stock, it's currently at a $378 billion market cap. So if AMD does become $1 trillion company, that would be over a 2x, almost a 3x return on where it is now. But as you can see, the news of the OpenAI deal sent the stock up from $164 a share. It ran all the way up to $235, and it's dipped a little bit. But on the backs of this new Oracle news of their ordering a lot of GPUs, it has surged again in the last 5 days. And so this estimate of $1 trillion in revenue is all about this big Oracle order, right? Oracle plans on initially buying 50,000 MI450 GPUs starting in 2026 and expanding through 2027. And this is going to raise the revenue per system for AMD for their rack scale products versus just selling their standalone GPUs. And so they will now have multiple huge whale customers, like I was saying, OpenAI, and now this Oracle deal is two distinct, different, huge locked-in revenue sources for them. And they have an ongoing relationship with Oracle, right? Oracle was early on the MI300. They also bought the MI355X, and they are also now coming out and purchasing the MI450 GPUs. So they have lock-in from Oracle, And I would say one of the big risks with AMD rather in the short term is that the story of and the revenue and the success of this Oracle partnership doesn't come out for, you aren't going to see those numbers reflected for about 2 years, right? So if there's any misstep in timing, delivery, market perception, it could cause volatility well before those revenues hit the financial statements. So that's one thing about AMD, but AMD looks like a long-term potential buy and something to look into further. So those are the 3 ideas. And again, like I said, sign up for the free newsletter in the description for 3 stock ideas per day. And I will see you in the next video.